Let's jump in because we have so much we want to talk about. Welcome everyone to Quiet Light's monthly webinar series. This is the month of December. If you're watching a recording, welcome. Thank you for tuning in. Today, we're going to talk about the M&A industry, all of the lessons we learned from 2022, how you can apply those to 2023 to have a successful transaction, and so much more. So we're going to jump in just a second. For those of you who might be new to Quiet Light, welcome. We're happy to have you. Quiet Light is an entrepreneur-led company that helps other entrepreneurs buy, build, and sell their online businesses for 6, 7, and 8 figures. So entrepreneur-led, I mean that all of our advisors or brokers are entrepreneurs themselves. So they have bought, built, and or sold, and in many cases, all 3 online businesses themselves. So they're very uniquely qualified to help other entrepreneurs through this transaction process. A lot of what we do is educational. So webinars just like this. Our website has tons of articles and blog posts you can go check out. Our YouTube channel's got tons of videos. So go on to all those resources. And if you have any questions, as always, just let us know. Okay, let's get into the good stuff. So we've got 4 amazing Quiet Light advisors with us today. I'm going to introduce them very briefly, and then we will jump in. So first off, we have Jason Yelowitz. Welcome, Jason. Jason has started 7 businesses of his own, the first of which he raised over $10 million in venture capital funding for. And fun fact, in 2010, Jason joined as the very first Quiet Light advisor. So welcome, Jason.
Thanks, Sam.
Next, we have Amanda Robb. After starting purepearls.com in 2003, she launched 5 websites in the publishing industry. She turned them into multi-million dollar businesses and continues to start websites, buy businesses, and sell from her own portfolio. So welcome, Amanda.
Thank you, Sam.
Next, we have Pat Yates. Pat struck a Shark Tank deal with Robert Herjavec in 2014. He also grew a single slipper kiosk business into a multi-million dollar e-commerce focused business. And he has license deals with DreamWorks, the NCAA, NFL, and Disney. Welcome, Pat.
Thank you.
And last, but certainly not least, we have Ryan Condi. In 2014, he started a candy factory that is now in Sam's Club, Walgreens, and more. He has started 8 businesses, bought 4, and sold 2. He currently owns several online businesses, and he's the host of Let's Buy a Business podcast. Welcome, Ryan.
Thanks for having me.
Okay, amazing. So let's jump right in. Once again, for a reminder, if you have questions, there's a Q&A chat box right at the bottom of your Zoom screen. You can type them in there and we will get to them. And if you're watching this as a recording, there's a link below the video that will have a way for you to submit your questions to us. Okay, great. So first off, obviously 2022 had an economic downturn. Don't think that went unnoticed by anyone, especially not in the M&A industry. So maybe let's talk a little bit about what were the biggest impacts we saw on entrepreneurs and the M&A space, things that were maybe not what we expected. Jason, I'll start this off with you and let you guys kick it around.
Yeah, okay, thanks, Sam. As you mentioned, I started brokering in 2010, and that was kind of in the aftermath of the great financial crisis. And what 2022 has felt to me like how the year before I started was described, of it's kind of a rebuilding, reckoning year. Obviously, we're all aware inflation went sky high, interest rates followed, and increased interest rates are like gravity on risk assets. So the higher the interest rates, the worse the discounted cash flow looks, the higher the debt service costs, all that kind of stuff. My overall impression of 2022 is we haven't quite gotten to equilibrium. I think not all sellers have accepted that things have changed since 2021. And I think there's a lot of buyers that are lowballing as if we're heading into the next Great Depression. And I think those have to equalize. We have to find a middle ground. The good news is I checked out our transactions for the past 6 months versus that same period last year. We're down by 10%, but that's not overly significant. And the multiples are the same as they were last year. And the number of offers per listing is actually up this year compared with last year. So businesses are definitely moving, but there's some other metrics that have come down that I think sellers should be aware of, and buyers as well.
Yeah, I think in addition to that, Jason, I think you summed that up pretty well. Things have slowed down a little bit, but really not that much, and not as much as people would think they are. One thing that I've seen too is the timelines to sell a business has been extended. It used to be you'd launch a business and it would sell within 2-3 months, and now it's taking 3 to 4 months. And so from a seller perspective, going into 2023, they just need to know that, they should expect a little bit longer process. There's still plenty of buyers out there. The buyers are still very hungry. We've seen those multiples come down just slightly, but like you said, Jason, not as much as you would expect based on the downturn of the economy.
It's a good point, because from signing up with us to getting an LOI this year, it's taking 20% longer than it did last year. And I think anecdotally, most of us have experienced where last year we put out a listing, your phone starts ringing right away as a broker. This year, it's a little more paced. You'll get a call 2 days after you launch, 3 days after you launch, 5 days after you launch, 7. So I think the buyers are not feeling as much of a rush as they were last year.
I definitely agree. I think buyers are a little bit more conservative with wanting to react this year, because I think last year we had a little bit more of the FOMO, not wanting to miss out and just being first to put an offer in. And now they're wanting to sit and really evaluate and analyze, all of the metrics. And I think the other thing that we have that has changed in 2022 from the beginning of the year to now where we are is SBA lending, and just banks also becoming more conservative. Obviously, interest rates have risen. So there's a lot of changes that have happened in the bank lending landscape as well. That's made it a little bit more difficult. And as Ryan mentioned, it's taking a little bit longer to get through that process.
A couple of things I've seen on the SBA front too, Amanda, is a couple of the SBA deals I've seen and been a part of recently. We all know the SBA rates are up. I think they were probably about 6% at the beginning of 2022, and I think they're at 9% now. That's a pretty good jump. But I still think, from an SBA perspective, the debt is so inexpensive. If the deal didn't make sense at 9%, it's definitely not going to make sense at 6%, right? So you need to have those buffers that are going to be in there, I would think. What I am seeing from banks is they're a little bit more conservative on the multiples they're accepting or the overall price. And then maybe they're asking a little bit extra, it's not the 10% down, it's more like 15% down from a buyer, or, maybe they did it would have been 15% last year. Now it's 20% down. So they're asking for a little bit less leverage when it comes to that.
Yeah. I mean, I think that the three, they made great points. I think it really covered everything that's gone on in 22. I think that we saw such a rush of aggregator business in 2021. I think a lot of us, I remember us talking before this year or early in this year about consolidation and other things that might happen with aggregators and how the market itself could be, volatile, even if inflation did not happen. And I think that just threw gasoline on a lot of conservative, buyers. Now it's sort of flipped the market slightly to where buyers had a little bit of advantage. I was out with entrepreneurs in Las Vegas at a Shark Tank reunion recently, and a lot of them are really, really tired. And I know it's something we'll go into. And I think some of the issue has been the quality of business coming in. And some people have had to sort of look at their own multiples in their own business and decide if they do want to sell or if they want to wait into 23. I'm having those conversations every single time. And what was amazing about it is most of those entrepreneurs didn't realize they were in the same boat as everyone else. And they know that they have to make changes and they know there's a positive outcome. They just have to be patient enough to get there. And I think that's where we saw a little bit of a downturn. Some people having to be a little more patient for their financials and their business to recover from some of the things that they were doing, such as the import costs and freight duty and tax that, the import costs that were going up in 2021 and now inflation, it's a back-to-back hit for entrepreneurs. So that part is what I've been concentrating a lot on, is more the entrepreneur base versus the market.
Well, Pat brought up the aggregators. Amanda mentioned SBA lending might be getting more tight. I think in the aggregator space as well, the aggregators by and large all have credit committees. And one of the things I noticed in our own stats is our average deal size is a decent amount smaller this year than it was last year. And I think most of us on this call can remember last year, we were routinely closing 8-figure deals with aggregators because the aggregators were flush with cash and their credit committees hadn't sort of clamped down on them at that point. This year, I think we've heard a lot of anecdotal stories of buyers of bigger deals, particularly, a lot of them, unfortunately, aggregators, have gotten to kind of the 11th hour and then pulled out for one reason or another. And I'd be interested to hear the rest of the panel's opinion on that. But I think that might be why we're seeing a smaller average deal size, because last year it was kind of artificially skewed higher. And this year, I'm a veteran of the .com implosion 20 years ago. And I remember it like it was yesterday. it kind of feels the same to me. So we had a ton of aggregators, like, probably 150 of them raise ungodly amounts of money in 2020 and 2021. This reminds me of 1999 and 2000, when anyone with a .com in their name was out raising money. The whole point at that point was raise money and then try to prove your concept. Now now I think reality has hit. I think a lot of the aggregators have realized it's more challenging to run these businesses than it may have seemed on the surface. And then I think their credit committees are saying, okay, slow down on the acquisitions. Let's focus on running the operations well. And one suggestion I would have for potential sellers, again, I remember the .com implosion like it was yesterday. It did not resolve overnight. I think you need to make a real decision of, are you running your business for the long haul, or do you want to sell? If you want to sell, I think you do yourself a favor by accepting reality quicker, which frankly, that means pricing and terms are probably not going to be as good as a year ago, or be prepared to wait it out, which might be realistically 3, 4, 5 years, in my opinion, if ever, before we get to the kind of euphoria that we saw a year ago. So now I'm curious if the other panelists agree.
Yeah, I definitely do. I mean, I also think that the one thing that we're seeing, and of course, there's always anomalies, right? But a lot of potential sellers that I'm speaking with they witnessed 2021 as a standout year, right? Like there was this complete ramp up of sales in 2021, and 2022 has been either stagnant or a slight decline over 2021, and that's certainly affecting the overall landscape of what we're seeing, I believe, as well. Obviously, there are businesses that are still growing year over year, but certainly a large number of businesses saw 2021 as a standout year, and 2022 then is not quite as good, or they're stabilizing, they're maintaining, and therefore the multiples are reflective, right? Because a lot of times when we're seeing multiples, they're based on a return on investment and how fast the buyer can get that return on investment. And if the business is not growing, that multiple is going to constrict.
Which is interesting, because anecdotally, I agree with you. When I looked at the stats, the multiples were almost dead even. But I think what's happening is now I think there's some outliers that skew it. You've got the occasional business that's growing in this environment that gets a high multiple that might be skewing the average. But I think also a lot of businesses have declining revenue that at this point may have flatlined. So they'll still get a decent multiple, but it's on a lower, what we call sellers' discretionary earnings, than they would have had in 2021.
I still believe
absolutely
that part of the downturn is a halo of time too. We had a lot of deals working in Q1 of this year that probably skewed a little bit.
Right.
Had we started fresh, it probably would have been down a little more. But the beauty of it is like I've talked to some people, if you have a really good, clean business, your books are good, you prepared well, you do everything we talk about in like the Entrepreneur Playbook, there's a shameless plug for Joe, that if you're prepared for it, you have a great chance of still exiting your business. It's just, it depends. If your business is challenged, your books aren't good, and you have other issues, it's just adding one more issue to that. So I think preparation and making sure that you're in a position where your business is going to be able to close, provided you get an offer, is super important now, maybe more important than it ever has been.
Yeah, I really like that all those comments, and especially that last one with Pat, because at the end of the day, if you're building a great business, you can't time the market, you can't time anything. But if you're building a good business, there's going to be buyers that are out there. And I think in 2020 and 2021, you had entrepreneurs who didn't have things buttoned up, didn't have their books right. They were able to not necessarily cut corners, but they just didn't have things buttoned up that they probably should have. And there was so much frothiness in the market that it sort of made up for that. It made up for, not keeping your eye on the 8 ball, where now you do need to come to the market with solid books and solid processes and a great business. And I think overall too, and I've seen this across a lot of deals that, in the aggregator world, they were using someone else's money. They'll typically pay more for a business. They'll pay more cash up front. Now you flip it, and if you're using someone else's money, you're definitely going to probably spend a little bit more for a business than if you're using your hard-earned cash or your hard-earned money, or you're taking on a personal guarantee as an SBA buyer. Usually they're not spending as much on those multiples. And so I think you're seeing a couple of those shifts happen. In addition to, most e-commerce has had a down year from a banner 2021 year on top of that.
Totally agree with that. And I would say, in addition to having the books buttoned up and being a little more prepared to work for it to sell, I think realistic expectations are hugely important. So last year, I'm sure most of us took on a listing where we were talking to someone who owned a business that we liked, and we said, are you interested in selling? And the owner would say, well, yeah, if someone makes me the right offer, then I might be. And I think last year that worked for a lot of sellers and a lot of brokers. This year, I don't think you can take that attitude. This year, I think you have to come in with the attitude of, I want to sell. I know where my bottom line is. I know what I'd like to get. And I think you need to be prepared to accept what the market will bear. Otherwise, I think you're best to hold on and wait it out. I think expectations are hugely important now.
You guys have all sort of touched on that buyers are maybe doing a little more homework or taking a little more time. There's corners that can't be cut. Are there specific areas that buyers are flagging, like, oh, that's a red flag in a business for me right now, I can't take that on, or areas that they're really focused on paying attention to in terms of like key metrics or other aspects of the business that entrepreneurs should be aware of, that if they are looking to sell in 2023, these are areas that they should really make sure are buttoned up? And I can throw that to anyone if any. Oh, go ahead, Jason.
Yeah, so I don't mean to harp on buyers, but this year I've heard more things that in previous years we would have called them excuses. So it's not one particular thing. It's more like it feels like cold feet at the 11th hour. And then, look, there's no business is going to be perfect and check every single box to perfection. So what I've seen more of is, oh, we didn't notice this one box wasn't checked. We're going to exit the deal process, where I think the reality is more like, look, I've had a change of heart. The cost of capital has gotten more expensive, and I kind of regret that I offered what I did. So I'm going to say something nice to get out of the deal. That's been my perception.
I'm not sure if anyone else has any thoughts on that before we move on, Amanda or Pat. Or Ryan, but yeah, if there's anything that like we think that entrepreneurs, like, what are those boxes, I guess, that are they're not being checked, or is there something that before we wouldn't necessarily?
What?
Pat, I think you might have joined. You're on another.
Pat, do you want to mute?
No, it's a
No, I
Zoom
know what that is.
meeting.
I was just going to say, I think that like just from,
Pull that out.
Pat mentioned this earlier before we hopped on the call, but like supply chain, I think buyers might be more cognizant about, working with suppliers and their terms along with supply chain, and just making sure that there's no major issues there, just because of what sellers have gone through both in 2020 and 2021, and some business owners are still having supply chain issues, right? So I just think buyers are using a little bit more awareness, if you will, of what could potentially come down the line on that end.
Yeah. And I was trying to think about maybe some consistent things I've seen across deals. And I think that the whole supply chain that Amanda was talking about is a really critical one. A lot of times it's been improved, but a lot of times it hasn't for some industries and some countries and stuff. And what sort of flows into that, I feel like there's been more of a focus on your gross margins and your net margins, right? And in addition to that is how much money is being spent on advertising, right? What's your percentage of advertising across your total revenue? I feel like those have been bigger focuses, because if the business starts to go down a little bit and those numbers go up a little bit, if you're spending a little bit more to acquire that customer, then it's a double whammy, right? It's really painful for the entrepreneur and for the business owner.
And I want to even throw in sales tax. Sales tax has definitely been something that buyers, I believe, have become more aware of and focused on, just because more states are becoming stricter about Nexus. And if sellers aren't paying their sales tax in all the states that are, where they're passing that threshold of Nexus, it can cause issues for both the seller and the buyer. And so I actually have a deal right now that we're running into that issue. And so it's top of mind for me, but it's definitely something that's become more of an issue, and that sellers are either going to have to clean up on their end before they go to market, or that's something that has to be navigated through due diligence that can really cause complications to a deal.
Yeah, I mean, just to elaborate on that a little bit, I think that when I talk financially driven to most people. I heard one person say that inflation can be a great opportunity for a business. And some people really didn't know what he meant. But the idea is that you could look at your business, become leaner. You can raise your SDE by not raising your sales, that you can do a lot of things that make you leaner and more efficient in what you're doing in the business. So don't think it has to be going out and spend $100,000 on advertising to recoup $200,000 when you want to sell. I think that if you just come in, work with an advisor, talk to Jason, talk to Amanda, talk to Ryan, anyone on our team, and get guidance as to where you can improve your business and hopefully raise that SDE and get confident about a sale. I think that people just need to get some clarity to it and make sure they're prepared. And I think all those things will help.
I'm curious if the other panelists have seen something I've observed with a couple of businesses that have taken longer to move. I'll get buyers emailing me on like the 2nd of the month and saying, how did things go last month? It's sort of like a hyper focus on the trend, which almost feels like if a business is kind of in a slow decline, they want to see if they can catch the bottom. Have you guys experienced that with buyers, contacting you right at the beginning of each month to see how last month went?
I have not had one. Go ahead, Ryan. I'm sorry.
Yeah, almost 100% of the time on every deal. But I felt like that was the same in years past too. There's always this overemphasis of what's happened in the last 30 to 60 days. You could have a 10-year-old business and people are like, well, what happened in the last 30 days, right? And I think part of that is the buyers are always assuming the seller knows more. And of course, the seller always knows more about the business than the buyer. What I've been able to do there is, you don't have the full books on the 2nd of a month from the previous month. You just can't get the books done that fast, right? And, bookkeepers have dozens of companies that they're working with at any given point. But sometimes you can give them hey, this is the ad spend of last year or last month. And then this is the revenue of last month. So you can see general trends. But I think in a market like this, you will have an even bigger focus on what's happening over the last 30 to 90 days, just because there is that fear and people tend to overemphasize what's happening now than what happened 12 months ago.
I get a lot of emails of people asking about the market that are looking to sell or buyers. So we reply to those. But, again, it's just trying to keep looking at it from an optimistic standpoint for sellers, and for buyers, we just try to inform them as best we can.
In terms of, oh, sorry, go ahead, Jason.
Well, one thought I would give to buyers, for the last easily 13 or 14 years in the whole age of quantitative easing and Fed, easy monetary policy, we've really adopted this culture of other people's money. I want to leverage every investment. If I have $1 million to my name, I want to buy 10 different businesses with $100,000 down on each. That's become the mentality. Now, leverage can cut both ways, and it doesn't make as much sense in a higher interest rate environment as it does in a kind of a free money environment. So one thought I want to put out to buyers: if you're sitting on cash, you could probably get a better deal on a business if you come to the broker and say, I'm a cash buyer, I can close relatively quickly, I'm decisive, but I want a discount. I would think in a number of situations, you could probably get your discount versus a buyer who is relying on the SBA or some other form of borrowed money.
In terms of, was that someone else going to say something just now? No. Okay. Sorry. I heard an echo. In terms of 2023, so I know we talked about like the last 30 to 90 days. So I don't know if this is maybe too specific of a question. You've mentioned the last 6 months, what trends were in the last, like, say 30 to 60 days. How are trends looking in terms of what we could anticipate for even just early Q1 or Q2 of 2023? Do we think that with sort of the steady, like what's happening now is going to carry on? Do we see like major shifts coming? Is there anything like big waves that people should be aware of?
It's all obviously speculation when we're talking about the future, but I've certainly seen these waves in 2022 where it almost feels like risk on and risk off. Like for a month, my phone won't ring, no one's interested in a listing. And then the next month, I'll get 4 calls in one day. And it often seems to follow, financial headlines. And it seems to correspond with every time we get one of these rallies in the stock market, that those also happen to be the days where my phone seems to ring more for businesses for sale. When we're talking about 2023, as of right now, today, December 7th, It feels like there's pretty strong buyer demand. It's not going to shock me if we go through a couple more of these risk on, risk off kind of moments. But the bigger message that I'm taking, I think 2021 was the peak for quite some time. And I think it's going to be quite a while before we get back to that level of sort of exuberance.
I think Jason makes a great point. I think one of the opportunities that people will see in 23, I always try to look at this and try to figure out what's the positive for both sides. How can it become a positive situation? We're going to have to go through it. Most people speculate that we're going to go into, recessionary times in 23. Some believe it'll be worse than 22. Whether it is or not, we don't know, and we can't prepare for that. All you can do is prepare your business to continue to make sure you're doing the right things, continue to improve your sales, make sure you're not burning money out that you shouldn't. But here's the reality. Anytime the stock market's down, Jason will tell you this, he's the smartest guy you'll ever find with this. You ever want to talk about it? I'm sure he loves talking about it. If it's down, it's an opportunity to some. That's how it works. If your business is going to go to market, it might be that you have to take a little bit less for it. But if you still want to transition, you have a good business, it'll happen. If you want to buy a good business and you want to look at something that's a value, this may be the opportunity for you as a buyer. You may find some things that take some time. And if you're creative with the sellers themselves, maybe there's some owner financing or other things that people may be able to do in those things to be able to help you get into a business. I think that anytime difficulties like this come, there are opportunities that come out of it. I think the challenge is to find those opportunities within what you're looking for your business. Whether you're a seller or buyer, it still fits in. Just figure out what your goal is going to be and try to position it to where you can get there.
Would you say, we've talked about a lot of the things that we should be doing maybe slightly differently or focused on. What are some of the aspects of growing and selling businesses that's not changing no matter what? Like, it doesn't matter if we're in an economic downturn. It doesn't matter if we're in a 2021 glory year. Like, what are the things entrepreneurs should continue to think about when if they're considering a sale? And I can shoot this over to Ryan to start, but anyone feel free to jump in.
Yeah. So the first thought I had, Sam, was it sort of piggybacks off the previous question too. And you asked about timing and going into 2023. And my first thought always goes to SBA buyers at the beginning of the year, because you do need the last 2 years of tax returns, sometimes 3 years of tax returns to do an SBA deal. So naturally, you'll see more SBA eligible deals in February, March, and April after a business has just done their taxes from the previous year. Especially if a business is growing, you try to buy that business with an SBA loan in November. Well, the bank has to go off of year-old data when they're running their numbers. And so that's one thing that, just from a timing perspective, that's just from a buyer and a seller, right? You're going to see that more SBA deals will come in that first quarter to like beginning of second quarter of every year, that window. And in addition, from a buyer or from a seller's perspective, sellers always think SBA loans are actually for the buyers. They're for both, right? If more people can afford your business by putting 10, 15, 20, 25% down, then you just have that many more buyers. So it actually is very beneficial for a seller to get your business in a way that is SBA pre-qualified. We've talked about lots of different types of deal structures, and, there's pros and cons to an SBA deal, but the more buyers you have at the table, then you just have more options as a seller too.
Yeah, that I have to second what Ryan said. I mean, I was a little bit shocked recently. I had a potential seller who asked us for a price estimate, and we told him, and he said, well, such and such brokerage told me something different. And the first question I said was, did they get your business SBA pre-qualified? He's like, no, what is that? And it kind of blew my mind, because they're probably, tell me guys if you agree or not, I think there's easily 5 times as many SBA buyers as there are cash buyers, because simple math, there's a lot more people that have $200,000 saved than $1 million. And do you guys agree with that?
Yeah, it might even be higher, 10, 20x.
Yeah.
Absolutely.
It might be, it could be 10x. And it's just like, if you're selling your house, the more people that show up to the open house and look at it, the higher the odds that the price is gonna get bid up, whether or not the final buyer is using leverage or using cash. Just having more offers tends to help.
Yeah, and SBA buyers also put pressure on cash buyers and their terms and structures, right? So like, you usually get a better outcome when you have more buyers coming to the table based on terms and cash.
Yeah, and for any sellers who don't know, for SBA, as Ryan mentioned, the tax returns are really important. So we are well aware, we've all seen businesses where you give us your profit and loss statement and you're making $500,000. Then you give us your tax return and it shows that you're earning zero. This is one of those double-edged swords, guys. A lot of people want to save on their taxes, and that's understandable. We're all entrepreneurs. We all get the urge. The problem is, once you go to get it qualified with the bank that's going to be backed by the SBA, the bank is going to say, gee, your tax return shows zero profit. And then you're going to say, no, I earned $500,000. I was just saving on taxes. So then the banker is going to say, okay, who are you lying to, me or the IRS? It puts you in this catch-22. So you kind of have to make a choice of how aggressive you're going to be on your tax returns. If they're too far off from the P&L, you're not going to be eligible. Your business likely will not be eligible for an SBA loan.
We've talked, oh, sorry, go ahead, Ryan.
I just said that summed it up perfectly. That was great.
Thanks.
Very good.
We've talked a little bit about deal structure, and this is going to be a loaded question because I know every deal is very different. But in 2022, or even in the last 6 months, would you say you've seen consistent changes or ways that deal structures are being put together based on the current economic condition, or is it just remain like, you know, every business is different and any deal structure could look different? If there's any trends you're seeing, I would love to hear about it. And Pat, I'll throw this to you first.
Yeah, that's fine. No problem. I'd love to hear their opinion on it, because in the last 6 months, you know, obviously deal flow slowed down a little bit. Obviously we see that, you know, multiples are coming in a little bit. What I've tried to encourage people in challenging deals to do is think about what kind of structure can work versus what can't. So if someone's coming in, let's say, for instance, there's no SBA financing, it's a smaller deal, but you can't afford to put all cash down. If you work with them on an earnout that might be conducive, or seller financing, things like that, I think there's a barrier to entry that could be, you know, that hurdle could be jumped, and helping people get into it. So as far as deal structure, I guess I have to think of it as a hypothetical. So if we're going into a less inviting economic time, what kind of structures can work? Earnouts definitely work. Seller financing works. SBA, if you can get it, works. But I think that it's just going to be really important that people think creatively about how to make it work, because what I see, like Amanda and I are in the middle of a deal now. There's so many structure issues going on with the deal. It's just incredible, but everyone wants the same thing. So as you talk about it, I think it's a matter of understanding and being differential to the other sides and trying to find something that can do it. But I think there'll be a lot more earnouts and stability stuff in 2023, just because it's going to be a necessity if capital markets aren't going to support that.
Yeah, I also think it really just depends on the business, right? So like, it depends if, you know, what is the business, where's the revenue coming from? What is the brandability of the company? What are the perceived risks of the company, and how the terms are structured? And it certainly depends on how many buyers are making an offer. I haven't seen a ton of change yet with my deals. I'm sure there's changes happening. And I'm sure there will be in 2023 as things stagnate, if you will. But I haven't seen major changes. In fact, I just had a full cash offer on a deal, and they were better than all other offers, SBA buyers and whatnot. So, and that just came in within the last 2 weeks.
Yeah, and one of the things I always say from a deal structure perspective is that's where you're going to get a lot of feedback from the market, right? So, you know, if you've got a lot of buyers at the table, well, you're probably going to get most, if not all, the cash up front and get, you know, above asking or whatever, right? On the flip side, if you have no one else at the table and there's one person here, it's kind of like you walk up to buy a used car, you got all the leverage in the world, right? And so I think so much of deal structure is based on the business that has been created, the overall trends. Is it growing? Is it declining? What growth opportunities are in place? Do you have some new products that are queued up, ready to launch? All those things have a big impact on just the number of buyers, and then the number of buyers at the table all usually can dictate what those terms look like, whether it's more favorable for the buyer or more favorable for the seller too.
You know, statistically, in the last 6 months, we've seen about 20% fewer all cash deals. So that kind of reinforces, I think, what Pat was saying about being a little more creative. One caution I would give, so earnout deals, I heard Pat mention earnouts, which are performance basis, generally where you as the seller are going to get some share of future growth or future profit or something like that. Earnout deals are easy to get. So for instance, I could take almost, or any of us could take almost any business, send an email to our list and say 100% earnout, and we would have offers within 10 minutes because there's very little risk to the buyer. Now, the challenge is there is risk to the seller. So we've had some internal discussions about, for the deals in 2021 that involved an earnout, what percent of those earnouts actually got paid a year later, and the results were not wonderful. So my suggestion to sellers is certainly an earnout can help you get the deal done, but you need to discount it in your own mind. If the potential of the earnout is an extra $300,000, in my mind, I'd be counting that as maybe 50 grand or 100. What do you guys think?
It's spot on. Yeah. And so much of an earnout is you said the risk, Jason. As a seller, you're accepting more risk. As a buyer, you're hedging your risk. You're always sharing that risk when two people come to the table, to a point where when both are okay with the amount of risk they're taking, then a deal happens. From a seller perspective, if you are accepting a big earnout or even earnout at all, right? So much of that is going to be in the hands of how are they going to operate the business? What's their experience? Are they brand new to this industry? Whereas, if they've got 10 years in the industry and they've got 3 other businesses that are very similar to this, well, you've got a lot of confidence in them and being able to hit those numbers.
Yeah, and as these guys say, just to add at that, we had a conversation in 2021 of how to structure, and we spent a lot of time thinking about the structure of those earnouts, moving away from an SDE level or profit level, because there's too many arguments that will come up in the expenses that go to that. Make sure if you go out, no matter who you're with, whether you're with Quiet Light or not, and if you do an earnout, make sure it is tied to your revenue level, so you can actually actualize that without any kind of argument, and hopefully you can get in a position where it's paid out quick enough to where that extension, that extended time, maybe it lowers the risk by getting some of it quicker on a monthly or quarterly basis. That could be a way to be able to combat that. I think it's more about just finding the structure that will work with both sides.
Yeah, and that's a fantastic point. And just for anyone who didn't quite get the point, profit is something that people argue about. The buyer and the seller will have different definitions of which expenses should count for profit. Revenue, by and large, that's your top line sales. Generally, that's easier to agree on. So what Pat is saying is, an earnout that's based on revenue is going to be somewhat safer. It's still dependent on how the new owner runs the business, but it's going to be somewhat safer than an earnout that's based on some bottom line metric.
Great explanation, Jason.
And what about in terms of, obviously there's all sorts of online businesses, right? Are we seeing any trends in terms of like Amazon versus an FBA versus e-commerce versus SaaS versus content? Like, is it sort of the same, or are some businesses popping or having more struggles given the economic turn down, or do we anticipate some sites being, more interest to buyers in 2023? Jason, you look like you're going to jump in.
Yeah, well, I was going to say Amazon itself, their e-commerce business really is looking like it had a COVID bump. There was that period of time where everyone thought they're going to be at home and work at home forever, and they got used to buying their stuff online. And it seems like there's been sort of a shift back into brick and mortar retailers. So I think to some degree that's trickling through. But bottom line is, I think businesses that are solely Amazon are probably not selling as much as the other types. What do you guys think?
Yeah, I mean, I definitely think 2021 was an Amazon year, right? Like 2020, 2021, those were like record Amazon FBA years. I think 2022 has kind of normalized back to where we're seeing more interest across the board for businesses that are e-commerce diversified, SaaS, content-based businesses, things like that. So I do think we're seeing kind of a normalization across the board for many different things, right? So, and who knows what 2023 will bring, honestly, but I think that Amazon has certainly hit its peak, at least for the foreseeable future.
Yeah, well, so Amanda, I mean, you've been with Quiet Light for well over 10 years at this point, and yet you're still only 29 years old. It's amazing. But would you agree with me that if we went back 3 or 4 years ago, buyers were asking for diversified businesses? They like to see a bit of Amazon, a bit of Shopify, a content website that was driving traffic to it. And then all of a sudden in 2020, 2021, with the rise of aggregators, it became very much not only Amazon, but I want Amazon that only has 5 ASINs that are all hero SKUs that kind of thing. And it was almost like bizarro world. It flipped on its head what we were used to. And when I look at it now, again, there's probably 150 aggregators, give or take. But when you look at our list of buyers, it's tens of thousands of people. And I think for a while, the aggregators were kind of running the show. And now we're kind of going more back to our list of tens of thousands of buyers. And most ordinary buying entrepreneurs probably prefer diversity of revenue sources as opposed to too much concentration. Would you agree with that?
Absolutely, 100% agree. I think we're kind of going back to that free aggregator focus on 100% Amazon. They didn't want anything else outside of that, right? So
yeah. And by the way, I don't mean to come off negative on aggregators. If you're an aggregator and you're watching this, we want your business. We welcome you. We still have the Amazon businesses you want. We just want you to close the deal. You know, if you make an offer, we want you to
clear. Jason doesn't. Oh wait, like that. Actually, to expand on their point, I think you're exactly right. I think that in 2021, Amazon was all the craze. If you had 80-20 Amazon, 100% Amazon, it was like that. Because I understand the aggregators wanted consistency. They want to be able to send product into the same houses at the same time. They don't want to work hard at it. I understand that Amazon lowers down the amount of time. I think some people have pivoted to people owning their own brands, owning their own customers. Some of those things have become a little more valuable in this. I think that Amazon had nowhere to go but down in the focus of how someone's buying an e-com business because it was already the 80 to 100%. But I still think it's very strong. I see strong numbers coming out of Amazon right now, even though numbers could be depressed during the holiday season a little bit. I see some good numbers coming out of there. I think their FBA charges keep going up every year. Some people have moved away. The one thing that I have noticed on Amazon this year, a lot less Prime badges, a lot more shipping that's going to be more than 2 days. 3, 4, 5 days has become some standard. People have moved away from a little bit because of the cost and some of the supply chain issues. And I think that's helped, entrepreneurs keep a little more money in their pocket. I mean, I think that will help some people's margins. It might lower down and tap down that sales thing, but there's nowhere that Amazon's going. It's still going to be the big dog in any of these sales if they have it.
Yeah, and look, as a seller, if you have a true brand, a brand that has brandability and is recognized outside of just Amazon, you're going to have higher valuation because you have not only diversification, but you have a brand that can stand on its own outside of just Amazon, right? You have customers that are coming directly to you. You have social media presence. You have what would literally just stand beyond if something happened with Amazon, like one of your listings went down for a day, right? So like you're not, your business is not, the exposure is not so much. And so diversification, I think, is still really important to buyers.
What one point I'll make, I'm looking at a chart of Amazon, the company, of its stock price at 88 bucks. It hasn't been this low since March of 2020. In other words, the entire shoot up after COVID has now gone away. To me, that makes the argument of old-fashioned diversification of your business makes more sense than being overly dependent on one source of sales.
In terms of Ryan, I don't know if you were going to jump in. I didn't want to interrupt you.
No, I think that's summed it up perfectly. Yeah, having a diversified business, you're just not putting all your eggs in one basket. A lot of people went down the Amazon path because it was consistent and you could buy a bunch of brands and sort of do the same thing across the board. But I recently just saw an e-commerce business that was probably 30% Amazon, 70% Shopify, but 30% of their Shopify revenue was coming from SMS or email, which is a crazy high number that I see. And that just goes to show like they're not really spending any costs other than the email marketing platform that they're using to acquire those customers. They're very high margin. So, we're going back to the days of 4 or 5 years ago where you just had to build a great brand and a great business.
Yeah, it's an interesting point, Ryan. Would you guys agree with me that having a strong email list is potentially one of the most protected forms of marketing? Because anything else, you're usually reliant on some form of big brother, whether it's Amazon or Google algorithm changes or something like that. You're usually dependent. But if you've got your own internal email list, those are your customers. Do you guys agree with that statement?
Absolutely. Yeah, definitely. Especially if they're responsive.
Yeah.
Except for Google, it's Gmail, and they might send you to the tab you don't want to be in. But yeah, absolutely, I agree with that.
Yeah, I mean, I think email, I'm still seeing emails and monitoring on a regular basis, 35 to 45% open rates. Really, really good. So if people aren't doing that, they should be. They should be looking at targeted. If you don't have Klaviyo, take a look at it. You can target your customers. You can do anything you want. I think that is definitely, I mean, it is 100% a big part of it. I think it's going to be growing more over the next 2 years too.
Yep. And I think SEO might also become popular again, right? So like, other ways of marketing that kind of lost interest for a while. I think, it's gaining interest again. I'm seeing a lot of sellers actually move back into focusing on more optimization as a diversified revenue source.
Yeah, it feels like there was a period where SEO lost its luster because Google had done some major algo updates, and you would, we would get calls from business owners who said, I just lost 82% of my traffic overnight. Can you sell my business? Amanda, what do you think is different with SEO now? Like, are people learning how to be more sustainable? Are they doing less black hat and gray hat kind of link building and that kind of thing?
I think enough time has passed to really understand what the algorithms are doing and why they're doing it. So if you really, first of all, if you hire somebody to do it, or if you take the time to understand what's going into these algorithm changes, for example, like a lot of content businesses were impacted by the authority algorithm. Like if you had all of your content written by somebody of authority versus just a one-off piece of content, those websites were impacted versus the ones that had an authority figure writing the content. It's all about creating value by a trusted source, right? And so as long as you align to that, like you understand that you're going to get rewarded for it. And so I think a lot of business owners in that world are really understanding that they do have to put in the time and effort to do it. And as long as you play by those rules, you'll be fine and actually will be really well rewarded for it.
Have you guys seen many trends with PPC, with pay-per-click advertising, whether on Google, Amazon, Facebook, wherever, in general? Is it becoming more popular, less popular? Is it working better? Is it not working as well?
I'll kind of talk to that because obviously I'm still in that world and I talk to a lot of entrepreneurs. So when I was in my Shark Tank reunion, there were a bunch of conversations about that. And some people talking about how they believe that, Google's algorithm has changed so much, it really can't help them. If they're converting at 2.8 or 3.2 or whatever it is that they're converting at, they're not really putting money to the bottom line. They're just churning product. So I believe that Google AdWords is probably taking a little bit of a dip. Amazon advertising is still really, really good, but the problem is it's self-serving. So I think the algorithms are very favored to them. I'm not as great at picking out what that is, but I do think if there's any side that's dropping, it is definitely going to be Google. I think people that are doing display and video, and most of what the conversations that I've had have been around video. If you're going to do that on Instagram, you're going to do it on TikTok, you're going to start evolving your company into something that's a little more digital and video. That's where it's going to be held. So I don't know that it's a rescission. I think Google will drop because I don't believe in that algorithm. I think people search for that, click on a paid thing, then they go to Amazon, they search for it. You're going to end up paying 3 or 4 searches for one customer. That's how it ends up working. Amazon's more of a search engine than Google is. People don't realize that. If you're looking for a product, more people search on Amazon than they do on Google. So I believe that those things will continue to expand, but the more creative that you can be engaging with customers is going to be huge. And I don't think that Google is the best place to do that.
I've heard a lot of e-commerce. A lot of e-commerce businesses actually switching their ad budget from Facebook to TikTok. I have not advertised on TikTok. I'm not sure what that looks like. I hear that trend over and over again. On the flip side of Pat, what I've seen too, if someone has a repeatable process through Google PPC to acquire customers, buyers love that because it's been around for 20 years. People are very familiar with it. There are incredible buyers out there who are incredible at Google PPC. Where I've seen a lot of pushback is if you're 100% dependent on Facebook and those algorithm updates and the sharing of the data, iOS 14 update a couple of years ago, a lot of fear from a buyer perspective. So I'm not sure where TikTok falls into that, but I do see that if you are good at Google PPC, you'll have a lot of buyers that are going to be interested in that business.
Right, Ryan.
Yeah, Oh, go ahead, Jason.
Could you give a little more detail? I mean, most people have heard about this iOS update that happened, I think 1.5 years ago, and how it affected Facebook. Could you give a little more detail on that and whether you think there's anything that Apple's doing that could potentially affect TikTok advertising, since TikTok is very much in the news from a potential security threat
Yeah.
to Americans.
So I'll talk a little bit about the Facebook side of things. And this is all coming from, I talk to a lot of digital marketers. I have a lot of, Facebook advertisers, even my brother, but I have never run a profitable Facebook ad campaign in my entire entrepreneurial career. So just putting that out there. Basically what happened is about a year and a half ago, Apple had an update where it didn't allow for tracking across all the apps. And that's how Facebook became so efficient and so effective at gathering customers, is they knew so much about you. They knew your intent. They knew how many kids you had. And all this was anonymized, but it allowed Facebook to serve up ads that were very particular to you. Well, that all went away. And so Facebook has struggled to attribute who is who on because they don't share all the data. And they've also struggled to attribute actual sales back to their ad dollars. So now it's a lot harder to know if you spend $1 on Facebook, whether that leads to, a $3 sale on your website. So with all that in mind, and then back to your point, Jason, about Apple, and not to get too deep into this, but Apple's sort of doing the same thing, and they sort of shut down a competitor, but Apple, their own ad network is actually exploding, all in the, this is a different topic, but all in the fear of privacy, right? And in reality, Apple's just doing the same thing Facebook was doing before. Now, in terms of TikTok, I've seen a lot. Go ahead.
Yeah, how safe is TikTok if you're building an ad campaign around TikTok?
So I don't know a ton about TikTok. I just know a lot of people are seeing more success. The ROAS is significantly higher, and a lot of budgets have been shifting from Facebook, which hasn't been very effective in attributing $1 spent to $1 in sales, and they're shifting over to TikTok. It could be one of those things where it's early days with TikTok, and so there's just not that many advertisers on it, and so you sort of have this in the same rush in Facebook 10 years ago when they first launched, where you could acquire customers for pennies just because there weren't that many, or it could be something that's, the algorithm is so much more effective. And Jason, if you've spent more than 5 minutes on TikTok, their algorithm is incredible. You're going to spend a few hours on there. So
Actually, my wife and I sit on TikTok probably longer than we should at nights. And actually,
your Netflix.
Believe it or not, if you want user-generated content, find a way to make sure people get those in their hands on TikTok. Because I had one come up for my brand the other day that was unbelievable. And it's really a strong platform. I think it's going to get bigger and bigger, but I'm very new to it as well.
Amanda, you were going to maybe mention something about PPC, but if the moment's passed, that's fine. I just want to touch base.
Yeah, no worries. I was just going to second to what Ryan said about Google PPC, especially for those that have a system that works. With Google PPC, one thing I've noticed just with my own experience and then with sellers is that it's really about timing in historicals, right? So the longer they've been in and had that account and that history really does serve them well to be able to outbid and get better conversions than their competitors. And so if they have a proven system, they're kind of like grandfathered in, if you will. And there is a moat around that. It's defensible.
100%. Like I built one of my businesses on Google PPC, and after about 3 years, I discovered one of my ads had a typo in it. It was literally a misspelled word. So within that same ad group, I wrote the same ad without the typo. The one with the typo performed so much better because it was grandfathered. So that was an interesting experiment. You're totally right.
Yeah, I mean, there's some security around that. Even though PPC is getting more expensive and more competitive, Google does favor those accounts with history.
Yeah.
And we've talked a lot about how to mitigate risk, whether it's through SEO or PPC, the email marketing. Is there any other tactics you would recommend for entrepreneurs to take in 2023? Even if they're looking to sell or just scale their business when there are some unknowns in the economy, other tactics you would recommend for them? Go ahead, Jason.
I think we're in a period where long-term sustainable businesses are going to do better. There was a short time there where you could have something trendy, like for instance, you could sell face masks in 2020 online, and you might be able to flip your business because everyone thought, oh, that'll be the next big trend forever. I feel like there's more conservatism now where buyers want tried and true, as opposed to something that might blow up and be big. What do you guys think?
Yeah, I definitely agree, Jason. I think that, obviously, going into this time where I think across the board, everybody's getting more conservative about the data, the metrics, and just evergreen sustainability of different platforms and different marketing and the actual product that's being sold, the quality of the suppliers, think all of that in one big picture.
Yeah, I always think too, any business out there that has like a success before COVID, during COVID, and after COVID, it's incredible the amount of interest you have from buyers on that. And I can understand why. As a buyer, I want to buy a business that's 7 years old, that's gone through these ups and the downs. Whereas if you've got, a 3-year-old business, it's really hard to determine what happened in 2019. There's no data from 2018, right? So I think those are all critical pieces from anytime you see a business that's listed that has history to it, you're just going to have all these other areas to grow and lean upon that you wouldn't have with the business that's, 2, 3, 4 years old.
And that goes with Amanda's point that it's feeling like we're regressing to the market that or not regressing, but just turning more towards a market that's similar to what we had before COVID, before aggregators. It's feeling more traditional.
I think Jason really hit it on the head right there. I think that the aggregator model took a buckle in early 2022. Last year it was strike fast and ask questions later. They were basically trying to put offers in to beat people to market them. It's like, I need to get this done this week. When is your order? When is your offer deadline? Is it tomorrow? Is it by 5? I mean, it was such a fever pitch of getting it in. I think patience will abound in 2023. I think buyers will look deeper. I think that's why having a good business and clean books and everything that we've talked about, like Jason and Amanda and Ryan said, is all super important. But the great news is there's still good buyers out there. And other thing, if you have a business that you want to transition as like a lifestyle business or a family-owned business that you care about the buyer that's going to have it and not have an aggregator throw it in with 30 other companies, this is a great time to think about doing that, because individual investors will come out and buy businesses to keep and continue to run and give them their next life versus it becoming something that's transactional. I have several sellers that have had really adamant, I want my next life, this business, to be someone that can take care of it because my family built it. Those kind of things will be great opportunities in 23 to find individual people that you can sell your business to. I think that's a good opportunity.
That's great. And I know we're coming up against the hour, so I want to give everyone a chance to sort of give some like final remarks and recommendations. Amanda, I'll start with you because I know you have a hard stop. But any sort of final thoughts on 2022 and heading into 2023 that you'd like? We talked about so much stuff, so maybe we hit everything. But is there anything else you guys want to talk about? Amanda, go ahead.
Yeah, I mean, I think just in general, if you're a seller, I would say it's not all doom and gloom. I think just if you're building a solid business, if you have all the different facets that a buyer would want in a business, regardless, right? Like you're still going to do really well. I do believe that. I think that you're going to stand out above the rest. And so I would just keep focused and just keep doing a really great job at building a brand. As a buyer, I do think we're moving into a little bit more of a buyer's market. So, I think there's going to be definitely some leverage there in 2023, but who knows? We'll see. Great.
Ryan, you're up.
If there's anything from the last 3 years, no one knows the future. Just build a great business, and I always say too, for sellers, you can't time the market, but internally when you're ready to move on to the next thing, when the grass is greener, when your energy life cycle is for a certain project or business is waning. And if it starts to wane, don't sit on that business. You'll start missing customer support requests. You'll start missing inventory purchases that need to happen. Your business will start to go down. And the second it starts to go down, your multiples get hammered. So I always say, don't time anything, more of like just intrinsically, what your exit goals are, what your goals are for that business or your future projects or whatever's happening in your own life. And if those line up and you've built a great business, you should continue to look forward to selling. But if you still have a lot of life left in that business and a lot of energy left, then keep running with it and you can continue to build, because there's going to be buyers 3 years from now and 10 years from now. But if your energy is waning now within that business, then don't wait 3 years to sell it.
That's great. Thank you, Pat. What would you like to leave us all with?
Yeah, Jason, I'll fill the last 20 minutes between the two of us. Now kidding. Anyway, I think that I think interestingly enough, this is the first time that I would say it's really important to be involved with an advisor. I think that's one thing I talked to someone about. In 2021, you probably could have sold your company directly to an aggregator and had no issues. It was a seller's market. They were looking to do it. They were looking to close. In a tough market, you're going to need someone that's going to fight for you. She's going to get embarrassed. I'm going to say this. Amanda's one of the best I've ever seen in diligence. She actually is just amazing at making sure things get done. It is harder to close a business than you think. Having an advisor is going to do two things. It's going to give you the information like we've given you today, the advice that you need if you're going to sell your company or going to buy it. And then we're going to help guide guide you to make sure that it's done. I think things could have been done easily in 2021. I don't think they will get done as easy in 2023. So having someone you trust and care about and that they're going to help and be invested in your exit is really, really important. You don't have to list with us, but reach out, give us information, let us help you understand how to get your business to market and exit at maximum value. That's what we do. And I think it's even more important into 23.
That's great. And I know Amanda has to hop off. Thank you so much for joining us today.
Thanks, Sam. I enjoyed it.
And
Bye,
Jason,
guys.
you can take us home.
Sure. So look, my thoughts, like these other. So one interesting thing, people watching this may gather that there's differences in levels of optimism and how we look at things. The bottom line is, it really doesn't matter what your broker thinks. What matters is what a willing and capable buyer who is ready to write a check thinks about your business. And I think, you know, anyone on this panel or anyone at Quiet Light, or frankly at some of our competitors, are, you know, very, very good at helping you get things packaged up and go to market. If you're a 30-year-old entrepreneur, you were probably a sophomore in high school when the great financial crisis hit. And you've been living in what I will call a dream world where every agency of government has gone out of their way to make sure there's money in everyone's pockets and interest rates that are nothing. But now we're experiencing inflation. That's something that hasn't happened since I was a little kid. And I remember sitting in the car while my parents waited in gas lines because you could only get gas on even number days or odd number days, depending on your license plate. Inflation is a game changer, and so many of us have literally no visceral memory. And for a lot of the 30-somethings today, you probably don't have that much of a visceral memory of even the great financial crisis of 2008. You may remember your parents had trouble paying the mortgage or something like that, but they probably shielded you. The biggest suggestion I have is expectations management. Manage your own expectations. Decide if you want to sell. I think Ryan made an amazing point that if you feel like you're on your way to burnout, you want to start the sales process as soon as you recognize that, because it's going to take a while. And if you get burned out, the business is going to start to suffer, and that's going to hurt what you can ultimately get for it. But I think there's a big decision. Do I sell or do I not sell? Things are different now than they have been. Businesses are still moving. We're still doing plenty of transactions, but I think what Amanda said, it's more of a buyer's market than it was. And that involves some changes in expectations. And I don't think you're doing yourself any favors to talk to your buddies who sold a year ago and using their stories as your bar for where you should hold out to, because things really have changed. That said, I started brokering in the wake of the great financial crisis, and I did the most transactions in that I've done in any year. I did in 2010 in the wake of the great financial crisis. So deals certainly will move as long as your expectations are appropriate.
That's such a great positive note to end on. Thank you guys all so much for joining. And if you're watching this live, thank you for tuning in. If you're watching the recording, we'd love to hear from you. There'll be a link underneath this that you can submit some questions to us. But thank you all for being here today. This was awesome. And I hope everyone has a great rest of their day.
Thanks, Sam.
Thanks,
Thanks, everyone.